Well, good morning. Glad to see a big turnout for this always popular talk on what's going on with our money at the state level. You've all survived tax day, and now we're looking forward to just relaxing for the rest of spring. And I think that completes my job for the morning. The speakers are going to be introduced by Karen Stoffaker, who is a relatively new member of the Committee on Financial Matters and Retirement, and you might not have met her before. She has been a member of the Retirement Association for a while, though, and she's retired from the School of Business, where she was Assistant Dean and Director of the Business Careers Program, Big Business Careers Center. And I'm going to turn over the microphone to Karen.
Good morning. Our first speaker from Swib is Ms. Rochelle Caskin, and she's Deputy Executive Director and Chief Administrative Officer at Swib. She joined Swib in 2015, is that better? As Chief Legal Counsel, adding the role of Assistant Director in 2017. She has over 20 years' experience in advising and leading businesses and service organizations through daily operations, transactions, restructuring, and strategic planning. Before joining Swib, she was a shareholder in the corporate practice group at the law firm of Godfrey & Kahn, and she served as the managing partner of the firm's Madison office. She received her law degree from Chicago Kent College of Law and holds a bachelor's degree in journalism and mass communication from the University of North Carolina, Chapel Hill. Also, from Swib, we're pleased to have Mr. Edwin Denson filling in for David Villa, who is not able to be with us today. Mr. Denson joined Swib in July of 2018 as Managing Director of Asset and Risk Allocation. Prior to joining Swib, Mr. Denson served as the Managing Director of Strategic Tilting at the Canadian Pension Plan Investment Board. Prior to that position, he spent 13 years in asset allocation, currency, and risk management as a portfolio manager at William Blair & Company, managing member at Singer Partners LLC, and managing director and head of asset allocation at UBS Global Asset Management. Mr. Denson holds a BA in economics from Cornell University and a PhD in economics from Northwestern University. And back by popular demand is Mr. Robert Conlon. As Secretary of the Wisconsin Department of Employee Trust Funds since January of 2012, Mr. Conlon is responsible for overseeing the provision of employee benefit plans covering over 632,000 participants and over $108 billion, that's a B, billion dollars in assets. Mr. Conlon has over 27 years of public service experience in Wisconsin, including 13 years at ETF. Prior to his 2007 appointment to Deputy Secretary, he was the agency's Director of Legislation, Communications, and Planning. Before joining ETF, Mr. Conlon served as a senior staff attorney at the nonpartisan Wisconsin Legislative Council. A native of Durand, Wisconsin, he holds a law degree from the University of Wisconsin and a bachelor's degree from St. John's University, Minnesota. Certainly a distinguished panel today, and Rochelle is going to kick it off.
Thank you. No problem. All right, good morning. It is on. I have to say, getting this on today, I almost want to be up on the stage and doing like Hello Dolly, because I normally think of a lavalier, but I'm happy to have this and make sure you can all hear me. So good morning. I'm Rochelle Claskin. I'm the Deputy Executive Director at Swib. Thank you so much for the kind introduction. I did want to say that David Villa does extend his sincere regrets for not being here today. He's on a very short medical leave and will be returning next week, so he is very disappointed to miss this talk today. But we do have Edwin, who joined our organization last year as the head of our asset and risk allocation. And he'll be talking to you a little bit about our asset allocation today and sort of the things that we are embarking on this year at Swib. So as you know, at Swib, we have about $110 billion under management, of which 93% represents the Wisconsin retirement system. There are two funds in that system that I'm sure you're all familiar with: the core, which is our fully diversified fund, and then the variable fund, which is a stock-only fund. And maybe some of you heard last year, we also took on as a small, separately managed fund, the UW System Trust Funds also came under management at Swib last year. That's about $450 million that we took over from the regents and now report quarterly to the regents. I don't know if you know this, so if you, when you pass away, if you say in your will that you want the money to go to the UW Foundation, it goes to the private foundation. If you just say UW or any of the campuses, it goes to the state. And that's sort of the distinction between the public and private factions of that money. So that is how they've come into the different gifts over the years. All right, so let's kick it off. Now, we are going to be available for questions at the end of this presentation. And what I want you to know is we have a few topic areas here today, but we're happy to answer questions on really any subject in connection with Swib or the retirement system. Our goal is really to be able to answer your questions. Our stakeholder conversations are some of the most important things that I do at Swib. And today, if I don't have an answer, I'm happy to follow up with an answer. You're always happy to follow up with our communications department, and we will get back to you with information that you need. The other thing is that if you go to our website, which is unfortunately a little bit of a long name, but it's www.swib.wi.us. If you go there, we actually have lots of information that we have online all the time, including our board materials, upcoming agendas, information about performance, about asset allocation. We try to have a website that's very robust so that information is readily available. So today we're going to talk about organizational structure, our performance, I know a very important matter for you all, the asset allocation that Edwin is going to cover, and we're also going to talk about our peer cost comparison. So at Swib, we have sort of a simplistic kind of idea of what we call the Swib triangle. At the top is make money, because that's the most important thing that we can do. On the two corners, though, we have optimize costs and manage risk. So all those things come together at Swib to provide the best opportunity for maximizing returns. Every dollar saved is a dollar that goes back into the trust funds. So last year we had a bit of a reorganization at Swib. David Villa, who had been our chief investment officer since 2006, was renamed both chief investment officer and executive director. So we did have a change, and the board sort of took a look at the leadership that we already had at Swib and took the opportunity to really think about our structure. And what we did is we sort of reorganized into four different main portions. So the first part is administration. That's me. So I'm the deputy executive director, chief administrative officer. We're also really, we like long titles at Swib, apparently. So David needs two, I need two. And under me, we did all the administrative functions. So communication, HR, legal, corporate governance, compliance, communication. And then we have an operation and technology group, and we just hired a chief technology and operations officer, Julia Valentine, and she began yesterday. She's from New York. She headed up investment operations and technology for the Chanel family office, which is a significant family office. She worked at D.E. Shaw, which is a significant hedge fund, and also before that, J.P. Morgan, as well as a host of other jobs in operation and technology. We feel like it's a real coup to have her come to Madison. She has a 5-year-old, so she was sort of right picking to get out of the city and come to a place where it's easy to raise your children. And so she started yesterday. We're very excited. So all of operations, information technology, performance, and data management will be under her leadership. Then we have our investment management organization. That's where Edwin is as the head of asset and risk allocation. And we also have all of our internal groups there. So we have public equities, we have multi-asset. That's our group that sort of, we talk about invest in the cracks. So not just equities only or fixed income only. They look for opportunities that maybe the market isn't quite exploiting. We have a public fixed income group. And then we have sort of a larger group that we call PIMFA, which means nothing unless you get the initials, but it's private markets and funds alpha. And so in that group, we have private equity, we have real estate, we have venture capital, and we also have a group called funds alpha that helps with our external managers that we do have for some asset classes. And finally, we have agency business. That's our transformation edge. That's the group that manages our project management office when we're investing in our infrastructure to build up the necessary things we need in Madison to do innovative investment strategy right here. They're the group leading those transformation efforts along the way. Okay, so let's talk about performance. Last year was a disappointing year for markets generally. We all know that. The one thing about having a fully diversified fund like the core fund here, though, is that this, the negative 3.3%, though, looked better than almost every market indice that was out there. December was one of the worst months since the great financial recession, and it was unfortunate for the markets. Same with the variable fund, which is obviously an all-stock market. But as we like to say, time goes on, and the markets have bounced back here in the first quarter. Our preliminary results for the first quarter are 8.1% on the core fund and 13% for the variable fund. So while we did see that big dip, and you know, December 31st is an important date for Swib, it's where we cut off and do mark our performance, we have seen the markets come back significantly, and you know, a little bit of knocking on wood and throwing salt over your shoulder, whatever else, but we like it when the market is strong. You know, this is, as Edwin will talk a little bit, we're late in the business cycle, and we'll keep talking about when is, we saw some market softness last year. What does that trajectory look like? We are unfortunately not able to be perfect with the projections and sort of thinking about ahead, but we are thinking about a lower return environment, so we'll take the returns when they come. Now, one of the things that we think a lot about at Swib is how do you compare? So you'll see right here we have a benchmark. And what is a benchmark? What do we do? What do we use them for? So when we're investing in our asset classes, we want to say how we look against the market. There is an investment in Madison and Swib in our offices on Wilson Street about the people that you have investing your funds. It's a way to determine how we're doing. So we mark ourselves against a benchmark. Generally, these are broad market indices. In connection with the core fund, it's a roll-up of the different types of asset classes that we invest in to see how we're doing. And then every time we're above the benchmark, that means that you are getting more value for the people that work at Swib. Another thing that we think about, though, is comparing ourselves to our peers. And we have this by the LAB, which is the Legislative Audit Bureau, which is the legislative function that audits Swib every 2 years to report back to the legislature about how we're doing. We have peer comparisons that are done just in the marketplace generally. We have an independent performance consultant that comes into our board of trustees who also talks about performance. But sometimes when we're talking about performance, it's not always an apples to apples comparison, because as you know, the benefit of the WRS is that we're 100% funded and we have a risk-sharing design. So that means when performance is up and returns are up, there is a dividend that can be paid to retirees on their annuities. But if there are losses, then those dividends can also decrease. So we're very thoughtful of that design in connection with both our asset allocation and the risk that we take at Swib. And in connection with that, we also have a 100% fully funded plan, which means we're not trying to chase returns. We're not necessarily trying to hit home runs. So our goal is that when the market is down, we'll do better. We'll have moderate protection from those very lows in the market. But when the market is rallying high, we're probably not totally keeping up with the market either, because we have a more conservative asset allocation based on our risk sharing. So another way, when you're just looking at, a different fund and you say, oh, well, the S&P was returning at 15% and you guys were only at 10%. Why is that? Or I heard Minnesota was performing at 9% and you guys were at 7%. Any kinds of those comparisons. One way to think about those investment returns is to put them in the context of how well funded a different plan is. So at Swib, we're 100% funded. So that means, I'm going to use ooh, look at that. All right, so we're 100% funded. If we get 7%, that means the entire return of all the assets are getting 7%. But if you were a 70% funded plan, which is pretty common nowadays, I believe the average amongst public pension plans, I think, is in the mid 75%, something like that. If you're getting an investment return of 7%, that means there's only 70% of the assets to actually get those returns. So in fact, when you think about an effective rate of return, that effective rate of return is only 4.9% because 30% wasn't there to actually earn anything. And in fact, their underfunded liability will continue to increase. So in connection with thinking about returns, and this is a kind of a busy slide, but I'll just point out two things on this one. So if you look at 5 years, now this is the June 30th, and one of the reasons we're using June 30th and not December is not just to look better, but many other states use a fiscal day cutoff, so they're always at 6/30. We have a calendar year that we mark to. So you can see that at the top up here, 7.63 on a 5-year return is in fact not the highest here. It might be ninth, or it's actually maybe the lowest. No, second, it's ninth out of this group here. And however, when you look at funding rates and the more than 100% last year at Wisconsin and compare it out, and then look at the effective rate taking into that account, we're actually the highest effective rate. Now that's, you can play with numbers and make them say, of course, whatever you want, but I'd also want to point out that it matters that we're 100% funded. So on an effective basis, how are we doing against other plans who don't have 100% funding? We're doing better when you compare performance on all the asset classes and all the assets under management. So sometimes just a straight comparison isn't really apples to apples, even when it seems like it is. All right, I'm going to let Edwin take over and talk a little bit about our asset allocation, and then I'll come back.
Okay, thank you. So, as Rochelle referenced in an earlier slide, our 5-year annualized return to the end of calendar 18 was 5.2%, and what we're showing here is that decomposition of that 5-year return on a year-by-year basis. So back in 2014, had an okay return of about 5.7%, flattish in 2015, and then a pretty good year in 2016 in terms of the total return of the core trust fund, and then an outstanding year in 2017, in a year that was very good for capital markets in general. And then again, as Rochelle alluded to, we had a bit of a negative return in the latest calendar year in 2018. But that was very hard to avoid, as every major asset class, including U.S. government bonds, experienced a negative return for the year. And as you recall, the fourth quarter was particularly challenging, especially for risky assets like equities or like credit. In some sense, there was sort of nowhere to hide in terms of avoiding negative return. Now, in terms of the context of this 5-year annualized return, I'd say that although it's less than the actuarial assumption of about 7%, it is higher than the 5% statutory annuitization rate. And very roughly speaking, I think that's why for this year the dividend ended up being unchanged from the previous year, because we did keep up with the 5% to support that. Looking ahead, this slide basically is trying to look ahead to the end of 2019 and see what we could expect for that 5-year expected return, including the current calendar year. And so in terms of this sort of projection, what we're simply doing is assuming that the rate of return for the current calendar year will be the same as the expected policy return given our asset allocation and given our asset allocation consultant's expectation for returns for the year. But you will note that this number looks exactly the same as the one you saw on the previous slide. That's not a typo. What's happening here is that this expected 6% return for this year is being added onto the 5-year calculation, and we're dropping a 5.7. Those two numbers are roughly the same, so when we look at a 5-year average, it's again going to look like it's going to come out just about the same. And again, I would point out that if this were to be the outcome, we would again have an overall return that was above the statutory annuitization rate, but a bit below the actuarial assumption. However, what I would note, as Rochelle referenced, is that so far, in actuality, year to date through the end of the first quarter, the core trust fund has returned about 8.1%. So if markets were to just remain flat from here on out for the rest of the year, we'd actually end up with more than 5.2% on the trailing 5-year basis. In this chart just is a graphical representation of our current asset allocation. You can see we have about 49% sitting in stocks, 25% in traditional fixed income, so it's just government bonds, 16% in an area that we call inflation sensitive. Those are TIPS, so those are the inflation protected government bonds, 8% in real estate, 9% in private equity, and then 4% in that area that Rochelle had referenced as our efforts to look in between the cracks and between asset classes. We call that multi-asset. Now that's the current asset allocation that we have for calendar 2019. That does represent a little bit of a change from the asset allocation policy that we had in 2018, but really just sort of small changes. We've shifted a little bit more into private equity from public equity and made some small changes in terms of the allocations within the asset classes. But overall, broadly, the same asset allocation that we were carrying in 2018. And then for the variable fund, again, which is an all-equity trust fund, there was no change there in the asset allocation. We have the same proportion in international equity and U.S. equity as we did last year, again, in terms of our overall asset allocation targets. Now the next slide has a lot more words on it than any of the other ones we've seen, so I would like to take some time to explain in words exactly what it is we're looking at. What we're looking at here is, firstly, the blue line is showing the cumulative return to our policy benchmark versus a very simple alternative that an individual could perhaps employ themselves. We call that a reference portfolio. And so when we look at the end of December, the distance between 100 and this blue line represents the advantage that's been provided in terms of return through our policy choices and through the complexity in terms of what we're able to employ in the investment board. So this value added is created by activities like being involved in private markets, like real estate, like private equity, and like private debt. It's also due to the very modest amount of policy leverage that we employ in the core trust fund. And then finally, this also is the benefit of having diversification in terms of our allocation to different asset classes. So for example, on the bond side, rather than being simply invested in government bonds, we're also invested in investment grade credits, high yield credits, emerging market debt. And then on the equity side, instead of simply being allocated to US stocks or to a very generic global equity index, we also have allocations to small cap and to emerging market equity. And again, this distance over the last 20 years, that's been built up over the last 20 years represents the benefits of that choice of policy. Now, the red line represents the overall performance of the core trust fund, again, versus the simple alternative. And the difference between the blue line and the red line is all of the active decision-making that we make around that policy. So, for example, it's the actual, in public equity space, it's the actual stocks that we've chosen. It's the particular private equity funds that we've chosen to be in. It's the particular bonds that our both internal and external managers have chosen to be. So again, this total distance from 100 to about 137 over the last 20 years represents all the benefit that's accrued from all the activity of the investment board. And again, decomposing that into the choices that we've made in terms of the kinds of markets we want to be invested in general, and then the additional value added to the actual selection of individual securities in the portfolio. Again, maybe a bit of a busy slide, so I'll take a few minutes to walk you through this. As Rochelle referenced in her comments, we do expect that over the nearer term, so say a 5 to 7 year period, that we will be in a somewhat low return environment, meaning that all asset classes would be expected to return a little bit lower than they would in the long run. And that leads to, over the medium term, us having a pretty modest expectation for what the policy will return over the next, again, 5 to 7 years. And what this emphasizes is the importance of that active management. So the importance of the activities that create the distance between that blue line and the red line, because in effect we're expecting the blue line, or the advantage that we have overall coming from just markets, to be a little bit more modest than we would in the long run. So what we're doing at the board is we're spending a lot of time on an effort on enhancing the ability to create the active return. So again, that's the distance between the blue and the red line. And here what you see is our sort of the range of active return that we expect to be able to deliver over the next 5 to 7 years. Now, I live in a world of percentages, that's how I think, but of course, you can't pay your bills based on percentages, it's actual dollar amounts. And so just to make the point, that would be a range of 300 million to 800 million per year that we're looking to try to add through our active investment activities. Now, again, even if we were to do as well as we think we can do in terms of the return, that 6.8%, if we were to get that, that's well in excess of the statutory annuitization rate of 5%, but again, still a little bit short of the actuarial rate of return. However, we don't expect this low return environment to last forever. If you look at the expected return of our policy over the longer term, over a 30-year period, we still expect that to be in excess of our actuarial rate of assumption. And again, these 30-year returns do include this nearer term period where we expect a little bit more moderate return expectations. I think I will leave it at that.
And I'll just take one more minute, because Edwin, the one point that I think is important to think about with these active decisions, so it is decisions about how to be in what asset classes, but one of the things that Edwin's division also does is they look at sort of the top of the house. We have this significant base of capital that we have and that we can use to our advantage, both from an economies of scale and how we're able to put it to use. And so some of the decision making that we do at Swib, and why we employ an investment group of both professionals and service individuals, is to help make those decisions. So, for example, at the end of last year, Edwin noticed, and his team noticed, an opportunity, given the dip in the market, in the equities market. in the equities market. So we overweighted equities at the end of the year and then was able to see so if we go back, so we have a general policy allocation, but then we make active decisions based on that decision that allow us to flex in a range of about plus or minus 6% in any one of these asset classes when opportunities are there. And so at the end of last year, we did about a 1% overweight. And again, 1% on $100 billion is a lot. And we went to that overweight and we were able to have a significant active return both at the end of last year and the beginning of this year that we took advantage of before we where we saw the value sort of window close, and then we closed out that trade. So those are the types of things that we do on an active basis that are beyond just passive investing. Those are the types of decisions that we think about to take advantages of opportunities in the market. We're doing in exposure management, which is what Edwin is in charge of, but also in any of the asset classes, we look for those types of opportunities.
I just didn't want to toot my own horn there. But,
yeah, so I'm always
but since
happy
you're going to put numbers on it, that kind of activity benefited the core trust fund by about $45 million in just the last 2 days of 2018, and then in the first month of 2019 contributed about another $45 million in value added.
All right, so we think about, again, that make money, we manage risk, and but we also optimize and think about costs, which come under my realm at Swib. And so again, for every dollar that we can save and be thoughtful about in a cost-conscious way, it's an actual dollar of assets that we are keeping within the core trust fund. So when we think about our peers, we think about, this is another way where we compare ourselves. We compare ourselves against in performance, and we also compare ourselves against cost. And our board of trustees has an independent benchmarking cost evaluation that is done on an annual basis to see how we do. So some of the difference that we have is, again, because not everything is apples to apples. Some things are apples to oranges. So our peers are investing differently. There are different costs involved in that. But overall, on an annual basis last year, we saved $90 million over our peers. Some of that is due to implementation style, the fact that we negotiate better fees with our external managers and for other services we get. And some of it is just based on the different types of asset classes that we're involved in. Now, thinking a little bit about why we do things internally versus externally and the mix that we're trying to do. So David Villa came in 2006 with a mandate to invigorate the internal management of assets at Swib. And he did a remarkable job of doing so. He's built up the investment management teams, the sophistication of our investment strategies to take advantage of that large capital asset that we have in the WRS. And in doing so, though, it also takes the investment within your entire infrastructure on an operations and technology basis. And so we've been managing a very sophisticated investment strategy, and at the same time, starting in about 2013, we've actually been investing in the services side of the house to be able to support that internal investment. And I think that this slide talks about that right now. So at the time of this slide, it's about 59% done internally and 41% externally, but you'll see on the other side here the difference in cost. So when we can do it internally, you see those costs are 18%, and the external version is 82, that difference. Now, some assets can only really effectively be done outside. So certain private equity, real estate, some advantages of some hedge funds, those are really things that we do need to spend, and they tend to be expensive asset classes. But in connection with internally, public equities, that multi-asset group, our public fixed income, doing the tilting that Edwin is doing, we can effectively do that internally at multiples less than what the outside external manager world is doing. Now, to be able to do that, though, on a sustainable basis, it does require investments in operations, in technology, in systems, in data management, and that doesn't come without a cost. But we think long term, and we think making investments over the long term and building that capacity in Madison, in Wisconsin, benefits the WRS. So our cost trends have been going up a little bit, so we don't want to hide the fact of that. We actually, for a long time, until about 2013, weren't making the right amount of investments internally and have changed that trajectory over the last 5 or so years. But we believe that when you look at the cost advantage that we can have internally, making those investments matter, having state-of-the-art systems so that we can manage the very sophisticated and difficult risk analysis and market valuations that we are doing. So while the gap is narrowing, we still do have our cost advantage. And when we look over the long term, we've actually saved $1.3 billion in the last 10 years over our peers, including that $90 million of last year. So in the long run, we have been very thoughtful about the dollars in the WRS that fund our operations. Again, we are stewards of that trust fund, both as fiduciaries and as making sure that, again, every dollar of return is something that goes to the core trust, to the WRS, and every dollar we save by not spending it. So we think got in at 2 levels. And then finally, sort of thinking about the difference between Edwin's blue and that red line, that active management, and comparing ourselves to the benchmark. So how are we doing above what we expected to do in that asset class alone, beyond just the decision-making of which asset classes to be in, which is where you get the biggest lift on differential. So over the last 10 years, we've added $2.7 billion above the benchmark, and in the last 5 years, $224 million above the benchmark, or in the last 5 years over that benchmark. So there is value that's after all costs. So that's after all the costs of managing both Swib, our offices, the 200 professionals that we have at Swib, as well as our external managers. This is after all costs. So we are adding value, and that's really how we keep our worth to you. We know we need those numbers to continue to have Swib and do an effective job of managing the WRS. So I think that now the next thing is we're going to take just a 5 or so minute break. Does that work for everybody? And then we'll come back and Bob will come and talk to you, and then all 3 of us are going to be available for any questions. And I do stress questions about what we've talked about today and then anything else you'd like to know. If I don't have the answer for you today, I will make sure to get that answer and get it to you in the future. Thank you.
With Mr. Conlon.
All right. Good morning. Thank you for having me back. It's not raining today. It's not snowing. It's almost nice. I don't mean to be ungrateful, but those who have seen my presentations before know I like to pace back and forth, and this is just way too confining. So I think we're going to do something about that next year. And standing up on stage, I feel so much more superior to all of you. It's just, this is not going to work. So if at any point I start yelling at you, don't take it personally. I'm just getting really frustrated from standing in one place. I will move around. It's my theory of being a moving target. I learned that after the financial recession of 2008. Never stand in one place for too long. So I am Bob Conlon from ETF, and I'm going to be talking to you today a little bit about some of the things we're doing at ETF. And I just wanted to introduce one more person from my staff, Nancy Ketterhagen. She's the one running around with the camera. She has the unenviable task of making me look kind of good, which then she tweets, and so this will be tweeted. I understand it doesn't hurt too much, but all the cool kids are tweeting. So we're going to be tweeting today, part of our engagement strategy to make sure people know what's going on with the WRS and what we're doing. So let's talk about what we're going to talk about. I want to talk a little bit about the health of the WRS and what's going on there. I want to talk a little bit about your health, which I think will be kind of interesting. Talk a little bit, what you all want to know is what's going to happen with annuity projections in the future. Everybody wants to know that. Nobody knows the answer, but I'm going to spend a considerable amount of time talking about it. And then talk a little bit more about some of the member engagement things we have going on at ETF. And then we'll get into those questions. So hopefully we won't make you sit too long for that. But Knowing all of you come out of the university spectrum, I kind of figure that no talk is appropriate without having a quiz first. So hopefully you all studied, or at least are good guessers. So first question, and I think this is generally known to most people, so hopefully you can get this one. WRS paid how much in benefits in 2018? What do you think?
D.
D. What's D? 5.4 billion. How many think 5.4 billion? Ding, 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 ding. $5.4 billion. And remember, about 75% of the benefits we pay out on average comes from investment return, okay? Again, that's why what Swib does is so important to the WRS and to the Wisconsin economy, because that 5.4 billion, I don't think it's going into your pockets and then you kind of save it. I think you spend it on things like food and gas and insurance and all that sort of stuff. So good statistic to know, $5.4 billion. Question number 2. What was the median WRS annuity paid in 2018? C? C, how many people think C? Yeah. Now, interestingly, I don't see any 6-figure numbers up there. So obviously, we put the wrong data up here. But the correct answer is C. $21,000 is the median pension paid to WRS retirees. Not the lavish lifestyle that many envision us living in retirement, but still enough. It's a decent amount. Question number 3. For those of you who are teachers, we got about 257,000 active employees in the state of Wisconsin. How many are teachers? D? How many think D? 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 Anything else? Yeah, A, B, C, or D. Yeah. We'll go with D. 39% of WRS active members are teachers. Pretty important. We keep our public schools going. The WRS supports that. Teachers generally earn a little bit less than they might in private sector jobs. The WRS is there to help recruit and retain teachers all across this state. Next question. If a teacher worked 22 years and was going 55 miles an hour and another teacher, if a teacher worked 22 years, what percentage of income does her WRS pension provide or replace? We have a difference of opinion. How many think A? How about B? A little more for B. How about C? And what about D?
D.
D. We got D. One D. One big D. The answer is A. 34%. On average, a 30-year career employee, the WRS, combined with Social Security, is intended to replace somewhere between 60 and 85% of your pre-retirement income. Okay? So again, it's not that 100% placement ratio we hear about in the press all the time, the fat cats living large on their WRS pension. 34%. 22 years, that's a long time to be teaching. All right, what's the age of the oldest WRS member? For extra credit, what's her name? All right, we'll just stick with this one. What do you think? D, I heard D out here. C? C, D, C, D. It's D, 107. Is that person here, by the way? Now, if you want to ruin an actuary's day, you give them this quiz, all right? Great news, this person has lived to be 107. The actuaries assumed she was going to die when she was 80. She beat the spread, she's doing great, and the actuaries are trying to figure out how are we going to pay for it. You've seen all the time, life expectancy is increasing. And that creates pressure on both ETF and Swib, because that's another payment that we have to continue to make. In the WRS, as people's life expectancy increases, everybody ends up paying a little bit more for it. You do as retirees, we make a little bit of adjustment every year in your pension payment so that we can continue to pay those benefits long into the future, so that we're not having to run back to taxpayers regularly to fill in that gap. All right, so how'd we do? Did anybody pass? That's all right, I'm not keeping score. So, WRS Health, how are we doing? I'm pleased to report that we continue to be in good financial health. It's a real tribute to the design of the WRS. It's a tribute to the funding discipline the state has had over time. And it's, I think, a tribute to you folks for being active and engaged in your pension system and making sure that legislators and other policymakers know how important the WRS is to you. So our funding methodology, that's what we use to set contribution rates. We are 100% funded on that. The market value, what's the value of the assets that we have to the liabilities, to the benefits that we owe? At the end of 2017, that was 103%. Given the investment performance last year, that's probably going to drop a little bit. I would expect it to drop into the 97% range or something like that. But that number, that market value number, that is going to be very variable. Every year that's going to be bouncing around. Our goal is to keep that around 100%. All right, make sure that we are well funded into the future. One of the largest public pension plans in the country, and about $108 billion in assets. Talked about earlier, $5.4 billion economic impact of the WRS into the state of Wisconsin. Now, I think this is interesting, but what gets really interesting is when you start looking at the specific counties. When you think of the WRS, you think, oh, geez, well, that's just the Madison people. They get all the money. No, we have money from the WRS going into every county, almost every municipality in the state. You look at Ashland and Iron County, way up north. That's $941,000 every month that's going into the Ashland economy from the WRS. 540 people receiving WRS benefits up there. Similar in Iron County. Dane County, of course, $70 million a month going into Dane County for 28,000 retirees. And then over on the right, you have big old Pierce County getting $2 million a month, and then tiny little Pepin County. Even Pepin County gets $400,000 a month from the WRS going into those communities. A lot of great people came out of Pepin County. One, anyway, that I can think of. My siblings didn't really amount to much, but it's a great place to live. The WRS continues to be a relatively low-cost benefit for taxpayers. In Wisconsin, state and local government spends about 2.1% of its revenue paying for pension benefits. The national average, about 4.7%. Okay? Think about that. Nationally, on average, states, local units of government spend 4.7% of their budgets on pension benefits, and they're not even fully funding them in most cases. We are a good value for the state of Wisconsin. Now, last year when I was here, I told you that the ETF board would be considering lowering its rate of return assumption. We do that every 3 years. We explore that. We look at it. We determine what the right investment assumption is given the investment climate that we're dealing with. Sure enough, in December, based on recommendations from the actuary, the ETF board lowered its assumed rate of return, the amount we assume that we're going to earn in the investment markets every year, from 7.2% down to 7%. okay? What that means generally, and I think some of you remember this equation, but in order to fund a pension, you not only need to have investment income, but you also need contributions. So employees and employers make contributions to the WRS. We invest that money to fund the benefits. If we assume we're going to earn less on investments, it means we probably need more money that we're going to be collecting from contributions. So that's the primary effect of lowering that assumed rate of return. We are very well funded now. We will continue to be well funded under this, and this will have a slight increase for active employees and their employers, ticking up just slightly in the years ahead. Now, as Rochelle and Edwin pointed out, the long-term outlook is that investment climate should improve over time, so we should see this going back up at some point. It used to be 8%, it came down to 7.8%, then it went down to 7.2%, and now we're at 7. 3 years hence, we'll be reviewing it again to see what the markets look like. But this is largely a blend of both kind of a short-term view as well as a long-term view. If we took the shorter-term view, we'd probably be down in the 6.5. If we took the longer-term view, we would probably be in the 7.5 to 8% range, but we can't do either one of those. We have to kind of balance the two. So that's why we're at 7%, but we just wanted to get back to you. You see the national median for the assumed investment return assumption is 7.25%. So we're still conservative based on that, but you can also see that that number has been consistently ticking down over the years as plans struggle to deal with the lower return environment. When Forbes is on your side, life can be good. There's a nice quote here. They have done some stories on public pension plans. I think if you read the national media, there are a lot of public pension plans that are in trouble. They struggle with funding. When you take 10 or 15 years off from paying contributions, it's hard to dig out of that hole. And it kind of shoves out other spending priorities if you have to put more and more and more of your budget into pensions. We haven't had that challenge in Wisconsin because of the unique design where we all share in the gains and the losses, and because of the funding discipline that we have paid contributions on time and regularly, and the amount that's supposed to be paid. We've done all the right things, and that puts us in a much better position. People are paying attention. I've noticed that I'm getting asked to go speak at more conferences to talk about the unique design. More and more plans are looking at ways that they can bend the cost curve, and the hot topic is risk sharing, gain and loss sharing, like we've known in the WRS for many, many years. Other plans are starting to look at that. I think that's a good thing generally, but it doesn't come without pain and it doesn't happen overnight. But public plans nationally are taking steps that they need to make themselves sustainable for the long term. So, health and wellness. Over the last couple of years, you've had folks from my health policy office come out and talk to you, usually in the fall, about your health benefits. One of the things you have been hearing about is our new data warehouse, where we are able to aggregate data, not personally identifiable data, but general health, disaggregated health data, so that we can start piecing together what the health looks like, what the spending looks like in our population, so that we can better control those costs. So we're starting to get the first glimpses of the data out of that data warehouse. And some of the stuff is kind of interesting. This is 2018 data. Here's something you probably wouldn't have thought of. Males had lower use of medical and prescription drug benefits than females. Gee. There might be a reason that women live longer than men. I don't know if this has anything to do with it, But, you know, come on, guys. I know healthcare costs a lot, but we want to get people in for preventive checks, prescription drugs that help improve their health. But that's some of the interesting stuff we're getting out of here. In Wisconsin, we have lower prescription drug costs than we see nationally. That's a testament to the good work, I think, that our pharmacy benefit manager does, Navitas, in helping us drive better prices for those pharmacy costs. But we also find that we have higher overall medical costs than the national average. And that's not an aggregated number. That's per health incident, we are seeing higher medical costs than the national medical average. And that's where we can start doing more, hopefully, in managing the health program to start driving down some of those costs. Preventive care services were used by 52% of the females in our population and 40% of the men. So again, overall, about 50% of our population uses the preventive services that are afforded in our health program, but the gender difference is remarkable, and it provides us an opportunity to actually do more, get more people engaged with their health care. There's a lot of feelings out there that healthcare costs are somebody else's problems, but one of the best ways to control healthcare costs is to take care of yourself, make sure you're getting the preventative services that you need so that you avoid longer-term, more costly chronic conditions. So that'll be part of our messaging going forward. Many of you are aware of our wellness program, the Wisconsin program. We've had good success getting people to participate in this. What this statistic is looking at, on average there was 2.1% decrease in health risks for repeat participants. So what we've tried to do is we've tried to separate out people who have participated in this program for more than 1 year, look at their risks when they started participating, and then after multiple years of participating. And we see that those risk areas generally go down for those who are engaged with the wellness program. Those top risk areas that we experience: weight, stress, cholesterol, blood pressure. And you can see by group where we've had the best success getting people to reduce their health risks when they participate in these programs. Interestingly, retirees, for some reason, have much better success at controlling their stress than active employees do. We are launching further investigations into that to see if we can bottle it. So anyway, I hope you have our health people out talk to you this fall. I think we'll have more data like this. Again, this is kind of the building blocks of how we start improving the health program and the health outcomes. A lot of providers of health insurance simply say the way we control health costs is to shift more costs to you, to cut benefits, to do all those sorts of things. They don't focus on improving the health outcomes. They don't focus on getting people engaged and healthier, which ultimately lowers healthcare costs. That's the approach we would like to take, and you all have to be part of that if it's going to be successful. So we ask you to stay tuned as we move forward with this. All right, annuity projections. Real quickly, this year, 0%. Everybody know that? Were they expecting a check? Because, sorry. We tried to brand this as a 0% increase, but it didn't make it through editing, so we're just going with 0%. You've seen after the Great Recession where we had some down, we started getting back into some nice positive adjustments. I think given the way that the market fell in December, we were very glad to be able to hold steady at 0. And hopefully this year's performance holds true and we see something better for next year. Variable fund. By the looks of people's faces, there are some here who participate in the variable fund. It's been quite a ride, and this year was no different, negative 10% return or annuity adjustment. Again, the core fund is smoothed over 5 years so that we don't get this up and down. The variable fund is not smooth, so you see the performance roll out on a more year-to-year basis. So when we look at annuity adjustments and compare them to CPI, to inflation, what do we get? Number one, fortunately, inflation has been pretty low of late. You see the 5-year numbers, the core fund has produced a return of about 1.6% on average. CPI has been about 1.5%. Over that same 5-year period, the variable fund returned about 1.2% on average for, and again, these are annuity adjustments, not the actual investment performance. So in the 5-year, core fund is outperforming CPI. If you come over here to the 35-year, over the history of the WRS, we're vastly outperforming CPI, which I think is a good thing. The 20-year, we're still pretty solid on the core fund. It's the last 10 years that have been kind of painful, and we hope to get out of that cycle. But that will be the challenge. If you were in the variable fund over the last 10 years, you've done very well for yourself, especially compared to CPI. But the core fund trails that a little bit, and that's something we have our eye on going forward. How well do we continue to hold up over all time periods to inflation? We know that in this risk-sharing environment, we're not a system where we guarantee you a 2% increase every year like a lot of systems, but we want to make sure that there is something there every year or as many years as possible so that you keep your heads a little bit above water. So when we try to do some projections about what may be coming down the road, we plug in various formulas. We assume certain investment performance. We know what's going on generally in terms of how many benefits we have to pay and that sort of thing. So we're able to project out a little bit what the annuity adjustment may be. Now again, these aren't predictions, but if investment performance goes as we assume, this is what we would expect to see. This bottom line shows what we would project to happen if the top line comes true and Swib earns 7% in 2019, 20, 21, 22. In other words, we are assuming here that Swib is going to earn the assumed rate of return each and every year. Now I'll turn to you guys. When was the last time you guys earned 7%? The answer is never. We never earn exactly what the assumed rate of return is. It's up or down. This is a long-term average, as I explained before. So you're very seldom gonna see it lining up perfectly, but we do this for projection purposes, just so that people have a sense of what the magnitude of annuity adjustments are. We think you'd like to know if there are negative annuity adjustments coming. Even if you don't like the news, you wanna be prepared for it and plan for it. That's why we do this. So this base case that we use is that Swib earns 7% every year the next 4 or 5 years going forward. And what you see is in 2019, if we earn 7% this year, and remember, we're already above that, and we're not going below it, as I understand it. Maybe I misheard. But if we earn 7% this year, we are looking at an annuity adjustment of 0% to negative 0.7%. How did that happen? When I stood here last year and talked to you, because we used the 5-year smoothing and we had good investment performance, we had about $3.3 billion of gains built up in the system, ready to flow out. 1 year later, after a very terrible December, we now have about $4.9 billion in losses queued up in the system ready to roll out over the next 5 years, okay? So those losses that accrued because of 2018 are a headwind for performance in the future. Okay, so just keep in mind that is out there. That's why you are seeing this rather anemic number here, because we've got negative numbers built up that will be kind of pushing down that 7% return. Now, if we're earning over 7% this year, that helps. It helps a lot. So even though this might be negative next year with a 7% return, we see some positives, very little in terms of red numbers there. So that's good. That generally means that we're at least on the plus side for most cases. We take another case, and this is a 5% return. Somewhat muted investment performance. So we see 5% in 2019, which again, we're above that today, but if we return 5% in 2019, but return to earning 7% in the next years, we're pretty much looking at a negative adjustment next spring. And I will be sending someone else to do this presentation. Okay, so that's 5%. Now, just for fun, what if we have a 0 year? You see a lot more red on this bottom line. Okay? So one of the ways that you get to a 0% return is you take a lot of risks that you don't need to take. When Rochelle and Edwin talk about Swib being very risk conscious, this is one of the areas where it comes into play. Now, last year was a negative 3.5% decline, but it could have been much worse had they been invested like other pension systems. If we see a 0% return this year, negative, 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 negative. Again, this isn't just a 0% return. We assume that we're going to earn 7%. So that 0 turns into essentially a 7% loss. Just like this negative 3.5% is about a 10% below what we expected to earn. That's why those losses build up and act as a drag. Now, being Irish, I don't look at the positive side, so we don't do the 8% and the 10% and the 12% because that's, that just gets you excited, and that's not fair. So I just want you all to be aware, if we're hovering around 0 to 7%, we're going to be bouncing around the 0 to 1% annuity adjustments in the core fund from year to year. All right, member engagement. What are we doing to keep people engaged? Aside from Nancy taking pictures and tweeting, we are actually trying to build more actual members into a lot of our communications. So we have tapped real live people who are participants in the WRS to kind of be spokesmodels for the WRS, tell their story. One of the things we want to do, I think retirees generally appreciate the benefit they have, but one of the things we're learning is that newer employees coming in really don't value or appreciate what the WRS offers. So we're trying to build that consciousness and awareness with employees. So this is Diane. She is a real live retired teacher. She's got a nice little quote there. We show her. Who else do we have? Andre is a county juvenile justice manager in Madison, working with kids, troubled kids every day. Marina is a training coordinator at Department of Children and Families downtown, making sure our professionals who work with children every day are well trained to handle the stresses, to get kids the help they need. Jim's got a hell of a job keeping our roads drivable, but he's got a smile on his face, so that's pretty good. He's up in Fond du Lac. Melissa is a high school teacher and an athletic director over in Beaver Dam, every day working with kids. Beaver Dam's had pretty good success with their girls basketball program of late. And then Bill. Bill's a retired state attorney. Bill happens to serve on the ETF board, so I know him. He was happy to participate and stand near a swamp somewhere. It's actually a very photographic area. But again, these folks willing to do this, they're not getting paid for it. It's not a way to increase their influencer status on Instagram or anything. But they believe in the WRS, and they believe in the benefits that it provides. You'll notice we didn't have any university folks up there. Talk amongst yourselves and get us some names of people who would be good at this. Also, in 2018, and something we're going to be doing regularly, is we engaged in a engagement survey. Rochelle talked about CEM being the entity that helps measure their costs versus peer systems. CEM also does a lot of work on the service side, and so they're into best practices, all that sort of thing. We partnered with them and about 8 or 10 other public pension plans, including the one of the Australian pension plans, interestingly. And the idea was to survey our members to try to get a sense of what our members think, how engaged they are with us and with their benefits. Basic questions we asked as applied to ETF, and all of the plans asked the same. They didn't all ask about ETF, but they asked about their engagement with their members. So how satisfied are you with ETF? I know ETF operates in my best interest. I feel confident my retirement is secure with ETF. ETF sends communications that are relevant to my needs. ETF acts ethically. Those were the basic sorts of questions. We sent out 96,000 or 92,000 emails to folks. We had a 22% response rate. Usually in these things you get maybe 10 to 15% if you're lucky. We had 22%. So that tells you a little something about engagement that we've got going on with WRS members right now. The average engagement score, when you take all the answers to all the questions that were asked, ETF's average score was 5.74. It's on a 1 to 7 scale. Our peers were at 5.65. So ETF is doing very well, we think, with engagement, making sure that we have a connection with our members, making sure that our members trust us, believe in us, can come to us. But we have some work to do. So when you look at general engagement across our participants, the green represents people who are really engaged. The blue represents those who are neither engaged nor disengaged. And the red are the people who say, I don't want anything to do with that. All right, so we don't have a lot of the red up there, so that's good. But we were able to break this down based on age categories. And you know, we got a lot of engagement going on with our retirees and, you know, people who are preparing for retirement. Makes a lot of sense. You start thinking about retirement, how it's going to apply to you. You start paying a little bit more attention to your benefits. When should you start paying attention to your benefits? When you're 20, when you come into the workforce. And unfortunately, too many people leave it go too long. So this is an opportunity for us. We're doing a lot of work. I think we've seen some changes as well since Act 10 perhaps, and who is filling the communication void with public employees. We need to step into that void a little bit more and make sure people are aware of what their benefits are. One of the questions they asked, do you feel you can live comfortably in retirement? So ETF is the red, and other plans collectively are the blue. And you can see again, retirees, people nearing retirement, they're feeling really good about their benefits. Newer people coming in, mid-career people, we got some work to do there. That's an opportunity for us to teach. But we can't do it by ourselves. One of the things I think is great about these sorts of groups is you've got a connection back to your colleagues at the UW. telling them how important this benefit is. A lot of folks coming from other systems, they might be in a TIAA CREF program or something like that. They don't know the value of a defined benefit plan. There's an opportunity there for both ETF and you folks to help people appreciate and understand their benefits better. One way that we're going to do that is we're going to be rolling out a new website this summer, June or July. It's going to be a more intuitive website. It will be written all in Latin so that people will understand things much better. But this is where you're going to start seeing, you'll start seeing more of the faces, the people who make up the WRS. Some of our staff, some people who work in the system. So keep your eye out for that. You can see we'll have it broken down by life events, returning to work, living in retirement. Hopefully it's going to be easier for people to find things based upon their stage of their career, which will hopefully start breaking down some of that communication barrier. That's what I just said. A lot of good information about that new website. 508 accessible for people with disabilities. It'll be easier for those folks, especially vision impaired people, be able to interact with them. Trying to get more into plain language so that people understand a little bit easier. One of the scores we fall down on in that survey I talked about earlier is how easy is it to understand the material we send out. I think the stuff we send out is thorough, if you're a lawyer, but we need to make it accessible to everybody else. Lastly, just wanted to talk about another way that you all can help out the WRS. We recently completed an election for a board member. I mentioned earlier Bill, who was in the pictures we shared. We had 8 candidates run for that seat that Bill won. That's remarkable turnout. It's been difficult to get people to give up their time to serve on our boards. But one of the complaints we got from a lot of people is that we had 8 candidates, and all of them were very qualified. They were all white men. And while I mentioned earlier that 39% of our population is teachers, 64% of our population is women. So there seems to be some sort of imbalance in terms of what you all do with your free time in retirement. We would like to encourage you when you see openings available, both racial, ethnic, socioeconomic diversity. We'd like to get more people, more representative sampling of folks who serve in the WRS, retired in the WRS, serving on our boards. So most of the people that complained about the lack of diversity were all eligible to serve. All they had to do was submit their name. They didn't do it. But we can do better and try to encourage those folks to actually submit next time. So that's another area where I think you can help us out a little bit when you see an opportunity. With that, I think we are at the point where we're probably willing to entertain some questions. Oh, there are no questions. Excellent.
Okay, can you hear? Okay. My question's about health insurance. This year debuted the Medicare Advantage plan from United Healthcare, and when people were evaluating whether to switch or not, your office presented a lot of positive information about what the advantages of switching would be. Roughly around the same time, there was some